Hi, guys, let's get started. This is Talking About Finance. My name is Dave Coker. It's Sunday, April 11th. Generally, this is 7 slides for 7 days, but so much is going on. I have so much to share with you. It's going to be 8 slides over the past 7 days. The first thing is this, and people aren't really paying attention to this, but without any debate, without any discussion, it seems the US government has adopted something called modern monetary theory, or MMT. Now, this is something that a lot of people have seized upon as a way that America can have its cake and eat it too. In other words, they can borrow massive amounts of money, but never, ever have to worry about paying it back. Hopefully, they'll debate that soon. There are ways to protect your wealth. We'll talk about those a little bit later. But you can see here, guys, we're going all the way back on this presentation off the wonderful Fred. We're going all the way back to the 1970s. And the blue line is total public debt, some 27.9 trillion as of February. And then the red line at the bottom is the budget deficit. And that's roughly 2.3 trillion. Now, keep in mind, the deficit is going to soar, as is the public debt, because Mr. Biden is passing trillions of dollars, or trying to get through, I should say, trillions of dollars of increased spending. And not all of it is really well intentioned. A lot of it is what in Washington they call pork. Regardless, guys, these increases are unprecedented. We've never quite seen this before. And when I mention that, people think it's hyperbole. I'm exaggerating. No, 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 no. Here's the chart. Here's the data. And we'll have to see how this ends. Again, we'll speak about protecting your wealth, because you can't trust the government. They didn't ask us if we wanted to do this. They just engaged in it. And now it's politically expedient to do so they can toss money into communities and effectively buy votes without thinking about the impact on future generations. In other words, young people who are going to be stuck paying this back unless something weird happens. But regardless, the US government borrows so they can spend. Where's the money coming from? And this is an interesting one. This is off FT. And I want to pay attention. Now, the headline talks about foreigners, but pay attention to the leftmost line. The Fed is the single largest purchaser of treasuries by a wide margin. And this is a misconception that a lot of people have when I present. I ask, who's the largest purchaser of treasuries? A lot of people say the usual suspects, China, blah, blah, blah. And it's not really true. In other words, the US government is the largest purchaser of the debt the US government issues. And then we've got foreigners behind it, and you can see households are in there. These are declining, though, when you look at households in particular. So it's very fascinating looking at actually who buys this stuff when the yields, the interest rates, as we call them, are at record lows. Well, it turns out that when you start to look at this issue, remember, we're global, so when you start to look at this issue, why would they invest in the United States? It gets down to something we call interest rate differentials. Here's the thing. I'm looking at 10-year yields across effectively 5 countries: the US, Canada, the UK, Italy, France, and Germany. We've got Q1 2020, Q1 2021. Now, there's a couple interesting things about this chart. First of all, you can see there's a big difference between the return you would get on a 10-year note, as we call it, if you purchased a US 10-year note, and if you purchased the equivalent instrument in Germany, you'd get a negative return. Or in France, you get a negative return again. Italy, you're not going to get much, about 60 basis points, 0.6%. Same thing in the UK. Canada, a little closer to the United States. So these nominal yields, they're not real. They're not net of inflation. These nominal yields are relatively high, so it drives capital or pulls capital into the United States. If you're a globally mobile investor, perhaps a fund manager, and even an individual, and you're living in Deutschland, wonderful country, I live there, wonderful place. But regardless, you're living in Germany, you're better off putting your money in the United States. All other factors remaining equal. And another thing I wanted to point out, guys, is look at these yields. We're looking at Q1 2020, Q2 2021, black and red respectively, and the yields are falling, which is, again, that's something fundamentally odd going on there. Well, when we borrow money and spend it, it's interesting to think about the idea of inflation. In other words, prices rising. And this is a big topic now. And again, most people don't look at the data. They look at Facebook, they look at the news. No, I look at the data, and that's why I've got a different view. So CPI, as we call it, Consumer Price Index, over the past year has run roughly 3%. We're measuring it from the trough of the Corona crash all the way up to the present. So it's roughly 3% over the horizon, a little bit higher than what the news reports. They constantly say it's about 1.9%, below 2%. And the Fed uses that as an excuse to keep printing the money. Well, guess what, guys? We're starting to see stress in the system. And 2021, as I say here, is going to be very interesting. Why? Well, inflation is just a myth. And I'm going to do a longer presentation where I go through and I break it apart, and I'll help you understand why the stated rate of inflation isn't the real rate of inflation. It's the same thing in the UK, guys. I track prices at a very detailed level, and inflation in the UK is running closer to 11%. Certainly not the 1.34 they tell us. And it's the same thing in the States. Now, this is the producer price index. And what this is the money, the prices that producers of services or goods have to pay. I've created this chart from January 2021 up to March 2021. I baselined it at 100. And it's pretty darn easy to see what's going on. It ran up to 105.9 in March 2021. Now, that doesn't necessarily translate into directly increased inflation. This is what producers of a good or service have to pay. Now, they've got a choice. Of course, they can pass the cost on to the customer. It'll show up in CPI then. Or another thing they can do is they can shrink their margins. Because basically what they do is they mark it up and sell it, and they can choose to absorb a little bit of the price increase. We're not sure how it's going to play out. But if this continues, if this trend with PPI continues, they won't have the latitude. They'll have to start passing cost increases on to the consumers. Then it'll show up in CPI. So what are you going to do if there's inflation? Of course, the usual refrain is buy gold. I thought what we would do is we'd look again from January 2021 up to the present. We're going to look at gold. In fact, I've got gold there. It's down 8%. But look at digital gold, what some people call Bitcoin. Bitcoin actually up almost 100, it's a 109% over the same horizon. There is evidence, and you can check out my blog, there is evidence that people are starting to move money into Bitcoin rather than physical gold. Physical gold has lots of issues, not least of which is what we call negative yield. You have to pay for storage and insurance. Well, with Bitcoin, there's no storage or insurance necessary. It just goes onto your wallet. Your wallet could be on your phone. It could be a Trezor wallet like I use, a distinct hardware wallet, or it could be on an exchange someplace. There's no carrying costs associated with it. So it's very fascinating to look at that. Well, another thing that you can do, oh, and guys, disclaimer, I have both Bitcoin and physical gold. Another thing you could do is you could buy shares. Something very fascinating going on here. And I've been talking about declining living standards in the United States for the past 20 years. I've been talking about this. We can see, this is very fascinating. We can see, guys, this is profound evidence that people are getting poorer in America. They don't invest like they used to. If you go back to the 60s, what you want to do is look at the big gray line, big gray area curve, at the bottom. And those are taxable accounts. Those are individuals. You can see that's been declining, and it's at 50-year lows. It's absolutely amazing. And look at what's going on with foreigners. Now, guys, again, this is something when I bring it up, a lot of people dispute it. They don't like it. When you run chronic deficits, when you're relying upon foreign entities to finance your profligate lifestyle, I'm looking at the government when I say this, foreigners are not stupid when it comes to money. They're taking the money they get when they invest in U.S. treasuries, the coupons, the interest. They're taking that interest and they're buying shares. In other words, we've been exporting wealth in the United States for decades. And again, when I bring this up, there's disputes, and you get the topical internet experts, as I call them, people that won't really understand this stuff. They find a chart, they find something that proves their point. Hey, I don't care. I got more money than them, I can tell you right now. And you can see here, guys, the data's right here. Foreigners are increasing purchases of stocks, and it's falling for ordinary Americans. In other words, who buys shares these days? Foreigners and rich Americans. That's it. The average man in the street does not invest like he or she used to do some decades ago, some 50 years ago. And we know that money is rushing into shares. Now, this is really cool. This is from Bank of America, and we've got global equity flows. The first column represents 452 billion that flowed into stocks over the past 12 years. And the right-hand side shows a much bigger number, 569 billion, that's flowed into stocks over the past 5 months. But we can't call it a bubble. People get a little weird and emotional if we call it a bubble. Back on the farm where I grew up, we used to have the duck test. If it walks like a duck, quacks like a duck, and craps like a duck, it's a duck. You can call it a pig all you want. It's still a duck. This is a bubble, guys, without a doubt. And we'll talk further about the stock market and what could set off a very precipitous crash when all this money comes rushing out. All right, guys, that's been talking about finance. Thanks for your time. Go forth and make some money. The U.S. is entering a very odd period right now. Stock market's booming, economy's booming. You can definitely make some money. You just got to be fleet of foot, select assets carefully, and get ready to get out real fast if markets turn against you. Have a great week, profitable week. Take care.